Great. Thank you, Matt. And thank you, everyone, for attending this investor webinar for an update on the Biotech Growth Trust. As Matt mentioned, my name is Geoff. I'm a general partner at OrbiMed. I've been a co-manager of this trust since May of 2005. On the call with me is my colleague, Josh Golomb, who's also a partner at OrbiMed. And each of us have over 20 years of experience investing in the biotech sector. Just to give you a quick update on OrbiMed, the firm that we work for, we are a global healthcare dedicated investment firm with over 25 years of experience investing solely in the healthcare sector. You can see on the left-hand side that as of the end of September, the total assets under management for OrbiMed was about $19 billion, and that was distributed across a number of business lines, including a very healthy and robust venture capital business. And you can see that on the right, the Biotech Growth Trust and its sister trust, Worldwide Healthcare Trust, represent a majority of our public equity business. Now, we do think we are differentiated versus some other managers, given our true global footprint. We have multiple offices worldwide. We can invest anywhere in the world, US, Europe, Asia. And we also have this very successful venture capital business that gives us an early look at some of the private companies in the biotech space that might be going public soon and so forth. And that helps in terms of our diligence on IPOs, on crossover investments, and so forth. We do have 148 global employees that bring over 300 years of investment experience to the organization, and we are continuing to expand our footprint. And about 34 of my colleagues have either an MD or PhD degree, so there's a lot of technical expertise in-house in the organization. Moving on to performance, here's a slide showing the performance of the Biotech Growth Trust since our inception as managers in May of 2005. You can see here the NAV of the Biotech Growth Trust here in blue versus the benchmark index, the NASDAQ Biotech Index, shown here in gray. And you can see going into early 2021, we had actually accumulated quite a bit of excess performance versus the index over that time span. But in 2021, we did suffer really an unprecedented, unwarranted drawdown in the biotech sector overall, especially in the small and mid-cap end of the universe. And this particular drawdown has really persisted much longer than we would have ever expected. And so we are still in the midst of recovering from that drawdown. I would note, though, that recently we've had very, very strong performance. We have been expecting a recovery in the biotech sector generally, especially in the small and mid-cap space. And we do think that we are poised for a very sustained recovery from current levels. So here, just to focus on performance for the current fiscal year, we do have a March 31st fiscal year end. So looking at the 6-month period from March 31st, 2025 to September 30th, 2025, you can see here that the Biotech Growth Trust NAV is up about 36% over this 6-month time span, well exceeding the performance of our benchmark index, the NASDAQ Biotech Index, which is up about 10%, so about 26 percentage points of excess performance in just 6 months. And one of the reasons that we've seen that performance is because structurally our particular portfolio is overweight mid-cap and small-cap stocks. So if you look on the left-hand corner or left-hand side of this slide, we have a table that shows the portfolio constituents of the Biotech Growth Trust classified into 3 market cap categories. Large cap stocks in excess of $10 billion in market cap, mid-cap stocks between $2 and $10 billion in market cap, and small cap stocks less than $2 billion in market cap. And if you compare the portfolio distribution across those market cap ranges versus our benchmark index and NASDAQ Biotech Index, you can see that at the start of this period, we were overweight mid caps and small caps versus the index and underweight large caps. And that's because we felt like the small caps and mid caps are really the undervalued parts of the biotech sector. So if one then plots the average stock price performance of the index constituents in each of those market cap categories, you can see that small caps in gray have significantly outperformed mid caps in green and large caps in blue. And obviously, given our positioning, we benefited from that performance divergence. If you look on the upper right-hand corner of this slide, we show the same table, this time taking a snapshot as of September 30th. And you can see that we are still overweight mid caps, still overweight small caps, and still underweight large caps. The small cap exposure has gone up in part because of the excellent performance of a lot of those names over the past 6 months. And we do expect that small cap performance to continue in the future. And the reason for that is actually shown by this slide. So this is a slide that plots a variety of indices over the past 4.5 years. So at the very top of this slide, you can see the S&P 500 in gray, up 84% since March 31st, 2021. Right below that in navy blue is the S&P 500 Healthcare Index. So this just consists of the healthcare constituents of the S&P 500. And you can see that actually, broadly speaking, healthcare has underperformed the broader S&P 500 for about the past 2 years. Below that is in light blue is the Russell 2000 index. This is a broad market-wide index tracking small cap stocks. And you can see that generally speaking, over the last 4.5 years, small caps have underperformed large caps. But the one I'd really like to focus on is the index at the very bottom in green. This is the Russell 2000 Biotech Index. This is a small cap biotech index, and you can see that it has underperformed the S&P 500 by an astounding 116 percentage points. So this is record underperformance. We've never seen this underperformance versus the broader S&P 500 for biotech in the history of the sector. And we just don't think that this underperformance is warranted given the strong fundamentals of the sector. We do believe that this performance divergence is going to resolve itself, and we should see a significant reversion recovery of small cap biotech in particular to catch up to the broader S&P 500. And one of the reasons why we have conviction in that is because this massive drawdown that has happened in 2021 and that has really persisted for the past 4 years has really driven absolute valuations for the biotech sector to unprecedented lows. And one very simple metric that we can look at to look at valuations for biotech is simply to look at the median ratio of the market caps of these companies to the net cash that these companies have on their balance sheet. And so here we have plotted that ratio since 2001. And you can see that 2021 drawdown that's persisted for the past 4.5 years has really driven valuations to record lows. We're trading at valuations below the dot-com bust, below the great financial crisis, below Hillary Clinton's election campaign, where she talked about drug pricing, and so forth. Now, having said that, we did see some flashes of recovery in valuation at the end of 2023 going into 2024. So there was a nascent recovery attempt in that time frame. Unfortunately, that was cut short due to persistent inflation, delays in expected Fed rate cuts, and after Trump's election, a number of new political uncertainties did get introduced. The appointment of Robert F. Kennedy as the head of the Department of Health and Human Services, budget cuts by the Trump administration that really weighed on the sector and unfortunately took valuations all the way back down to record lows. But recently, over the past 6 months, we have seen another recovery rally emerging. And that is because a lot of those political uncertainties are now abating. We've seen increased M&A activity for the sector, and rate cuts just last month have resumed. So we are entering a new rate cut cycle for the Fed, and that should be a nice tailwind for performance. So we do think this recovery is going to be more sustained, and hopefully valuations will get back to the historical average that we've seen in the past. Another way to look at absolute valuation is just to plot on the left-hand side the percent of biotech companies trading at market caps below the net cash on their balance sheet. And you can see that at the lows, close to 30% of the entire biotech industry is trading at market caps below the net cash on their balance sheet. You can see in historical context how anomalous and unusual this state of affairs has been. We've never seen anything like this before. On the right-hand side, if one looks at the number of biotech companies trading below the net cash on the balance sheet, again, at the lows, over 150 companies in biotech trading at market caps below the net cash on the balance sheet. We've never seen valuations that low. Now, fortunately, as you can see, over the past 6 months, we are starting to see a normalization of this valuation metric, where valuations are starting to come back to the historical averages, but there is still quite more to go in terms of normalization, and we do expect valuations to fully normalize over the coming months. So one common question I get is, well, this epic drawdown happened in biotech starting in 2021. Why did that happen? It's difficult to really pinpoint the exact cause, but certainly one contributing factor has been the fact that interest rates were rising over that period. So what we've done here is taken the 10-year US government yield and plotted here in black since 2005. And you can see that sure enough, in 2021, when the drawdown first started occurring, we did see a rapid rise in 10-year treasury yields over the next couple of years due to skyrocketing inflation and investor expectations that the Fed was going to raise rates to combat that inflation. And in fact, that's exactly what the Fed did do. Here are the Fed rate increases that occurred across 2022 fairly consistently and into 2023. Now, that policy was very successful in actually getting inflation back down. So inflation did peak in the middle of 2022. It's basically been declining ever since and getting towards that stated FDA or stated Fed target, rather, of 2% inflation per year. But certainly, this increase in 10-year interest rates didn't help the biotech sector. The reason why this metric or this interest rate is relevant for biotech is because it's the risk-free rate that we use to put into our discount rate in order to discount back the future cash flows that we're expecting from biotech. Higher discount rate, obviously, the lower the valuations for the stocks at the current time. So far, though that 10-year rate has remained stubbornly high, but encouragingly, again, just last month, the Fed has started cutting rates again. We do expect this month another Fed rate cut, and investors do expect in December, the next time that the FOMC meets, there will be a further rate cut. So we are now going from a rate increase cycle to now a Fed rate cutting cycle. And so the interest rate picture should be a tailwind for biotech performance. So I think, one of the major messages that I've said repeatedly over the past 4.5 years is that the valuation contraction that we've seen in the biotech industry is really unjustified based upon the fundamentals that we're seeing in the industry. We are really at a time where innovation in the biotech industry is at an all-time high. And let me just share with you a couple of slides demonstrating that. So the first slide I'd like to show here is the key breakthroughs that have happened in biotech in just this year, 2025. Here are just some selected examples of key clinical breakthroughs that have happened in the biotech sector. I'll just highlight a couple of them. uniQure in the middle of this slide, they recently announced very positive clinical results for their first-in-class gene therapy for a rare neurodegenerative disease called Huntington's disease. And this particular disease leads to progressive muscle weakness and cognitive deficits and so forth. In this trial, it showed that over a 3-year time span, this gene therapy resulted in a 75% slowing of disease progression for these patients. So a tremendous clinical benefit. We do think that this particular gene therapy has multi-billion-dollar potential. Another one I'd like to highlight is Abivax, the third one from the bottom. They also recently had very positive phase 3 results for their first-in-class MIR-124 enhancer, completely novel mechanism of action, and demonstrated very positive clinical remission rates in patients with a disease called ulcerative colitis. Again, we do think that actually that's going to unlock a multi-billion-dollar potential drug. And both of those names, uniQure and Abivax, we actually think are likely M&A targets for large pharma. So great science going on in the sector, and that is leading to marketed products. So here is a slide showing significant FDA biotech approvals thus far in 2025. Some of them are for sort of niche indications like acromegaly. Others are for more common indications like acute pain. But on the very right-hand column of this slide, you can see the word first in bold for every single entry on this slide. And that is because every single drug approved here on this slide is groundbreaking in some way, either because it's the first drug approved with a novel mechanism of action or the first drug approved for that particular indication. So a lot of groundbreaking science leading to marketed products. And I just wanted to highlight a couple of therapeutic areas where there's been particularly significant innovation of late. The first one I'd like to highlight is the area of oncology. Cancer remains the #1 therapeutic area for biotech drug development, given the significant unmet need in this disease area. And what we've displayed on this slide are 6 very novel cutting-edge technologies that are currently being applied to develop therapeutics for cancer. So we have cell therapies, we have antibody-drug conjugates. These are antibodies fused to chemotherapeutic. When injected into the body, the antibody actually binds to the tumor cells, delivering the chemotherapeutic directly to the tumor to kill those cells. We have bispecific antibodies. These are antibodies that bind to 2 different targets simultaneously. Targeted therapies. These are therapies that are geared towards tumors with specific genetic mutations. We have radiopharmaceuticals. Again, these are antibodies that are now fused to a radioisotope. So the antibody will bind to the particular tumor in question and deliver the radiation to kill the tumor directly at the tumor site. And then lastly, cancer vaccines, which encompass a number of approaches where you're harnessing the immune system, stimulating the immune system to actually attack the cancer directly. Importantly, every single one of the technologies on this page has already shown positive clinical benefit in human clinical trials. So these are all successful technologies from that perspective, and they are generating clinical benefit across different tumor types. So this is going to give physicians really a great toolbox to draw from in terms of treatment options to extend the lives of cancer patients. Next therapeutic area I'd like to highlight is actually the area of central nervous system diseases. And this really encompasses a broad number of both neurologic and psychiatric disorders that really offer large chronic market opportunities for the companies involved. So we have companies that are developing antipsychotic therapies, companies developing treatments for depression, for epilepsy, pain, neurocognitive disorders like Alzheimer's and Parkinson's. That's a significant unmet medical need. We have other biotechs developing treatments for neuromuscular disorders, movement disorders. And so on this slide, we've actually marked with an asterisk particular names that actually are in the portfolio of the Biotech Growth Trust as of September 30th. So we have nice exposure to a lot of these disease areas. And notably, this is also an area where large pharma is particularly interested. So they have an interest in the CNS space, given the market potential for a lot of these drugs. And they've made a number of acquisitions, actually, of biotech players who are played in the CNS area, including Intracellular Therapies, Karuna, Cerevel, Longboard Pharmaceuticals, and we do expect, hopefully, a number of future M&A transactions to occur in the space, and hopefully some of them are names that we hold in the portfolio. So as a shareholder of the Biotech Growth Trust, you will get exposure to a nice cross-section of the cutting-edge technologies that are currently being applied in biotech. We've listed a number of those technologies on this slide, along with the percent NAV exposure that the fund had to that technology as of the end of September. And we've also listed at the bottom some examples of portfolio positions that are applying that particular technology. Now, this is a dynamic sector. We do take a bottoms-up approach towards identifying stock investments for the portfolio. So our allocation to each of these technologies is going to dynamically change depending on where we see the most compelling investment opportunities. But overall, I think as an investor, you will get exposure to all the latest, greatest science that is occurring in biotech today. Now, moving on to the regulatory environment, what does the regulatory environment look like right now? Well, it's been very, very constructive for the approval of new drugs, frankly, for the past 8 to 9 years. So here's a slide showing the number of new drug approvals at the FDA each year since 2016. You can see there's a nice uplift in the number of drug approvals in 2017. That was the first year of Trump's first term. And that elevated level has really persisted for the past 8 to 9 years. The FDA really has been very proactive about trying to get novel drugs to patients as quickly as possible. They've been very flexible about the endpoints that they're requiring for clinical trials in order to get approval. And so we've had this very constructive FDA that has led to a really elevated number of drug approvals per year that's persisted through the Trump's first administration, through the Biden administration, and now seems to be continuing into Trump's second administration. If you look on the very right-hand side, 39 new drugs have been approved year to date for the first 3 quarters of the year. If you extrapolate kind of the run rate on an annualized basis, you can see the dotted box there. We're now tracking at a level where the total number of drug approvals that we expect in 2025 is on par with the elevated level we've seen over the past 8 to 9 years. So very constructive regulatory environment. Turning now to M&A, this has been a historical driver of returns in the biotech sector. Here at the top is a graph showing announced public biotech M&A transactions on a quarterly basis since the beginning of 2018. You can see that there was a flurry of activity in 2023, a little bit of a lull in the back half of 2024 as those large pharma companies digested some of those acquisitions. But great to see in the first half of 2025 a nice uptick in M&A activity. And we do think that M&A activity has the potential of accelerating even further over the coming months. If you look at the lower left-hand corner of this slide, we have a number of quotes of big pharma CEOs from their earnings call talking about the importance of M&A as a core part of their business strategy. And in the lower right-hand corner, we have a number of examples of transactions where the Biotech Growth Trust actually owned the M&A target at the time of announcement. So as a shareholder of this trust, you will benefit directly from a lot of this M&A activity. Now, one of the principal drivers for the M&A and why we think M&A activity is going to accelerate over the coming months is because big pharma is facing patent expiration and loss of exclusivity on a lot of their blockbuster drugs right now. And so here on the left-hand side, we have a graph showing branded sales at risk by big pharma, where a lot of their blockbuster drugs are either going to face generic or biosimilar competition by the end of this decade. On the very right-hand side of the slide, we have some examples of key blockbuster drugs that are expected to lose exclusivity by the end of this decade. And so what are these big pharma companies, what do they need to do? Well, they're going to need to acquire biotech companies with products that have multi-billion-dollar potential to offset that upcoming revenue cliff. And that is what they've been doing. We expect that to continue again over the next several months. One other area that I like to highlight actually is the rise of innovation in China. So we do have a global mandate at the Biotech Growth Trust. We are tasked with finding the best biotech investment opportunities worldwide. And so historically, we've actually had some exposure to Chinese biotech. But on the top half of this slide, it explains why we have that exposure. Here's a graph showing the number of phase 1 to phase 3 trial starts based upon where the company is located geographically from 2009 to 2024. And you can see in the upper right-hand corner, China in light green now accounts for 30% of clinical trial activity worldwide for the biopharmaceutical industry. That number exceeds the total clinical trial activity in Europe and is rapidly approaching actually the 35% market share in the United States. I would not be surprised that in the next several years, China actually overtakes the United States as the principal geography for clinical trial activity for this industry worldwide. Now, why does this happen? Basically, China announced in 2015 that they were going to prioritize developing a domestic biotechnology industry. They did that as part of their 10-year Made in China 2025 plan. And so with that explicit government support, sure enough, we've seen a lot of development of the Chinese biotech industry over the past 5 to 10 years. Chinese companies' R&D capabilities, we think, are now on par and in some cases better than their US peers. They can conduct clinical trials faster and cheaper than their Western counterparts, really shortening the development times for drugs. And this hasn't gone unnoticed by big pharma. So a lot of big pharma companies have recently been in-licensing promising assets from Chinese biotech for development in the US and Europe. Now, OrbiMed as an organization, we do have, they're special in the sense that we are one of the few firms out there that actually has a local analyst team. We have 3 individuals based out of our Shanghai and Hong Kong offices who can do diligence on those Chinese biotech companies directly. And we've had a lot of success in identifying some nice investment opportunities in that geography. If you take a step back and look at performance of Chinese healthcare, here's actually a graph of the Hang Seng Healthcare Index. This is a healthcare index that tracks the Chinese healthcare companies that trade on the Hong Kong Stock Exchange. You can see that since the middle of 2021, when sort of the index peaked, we have seen a pretty pronounced drawdown in the Hang Seng Healthcare Index. That was due to COVID restrictions, due to a weak economy in China coming out of COVID. But fortunately, recently, over the past 6 months, we have seen a nice rebound in China healthcare, and that's principally been driven by the innovation we're seeing in Chinese biotech, the business development deals that have been signed between Chinese biotech and Western big pharma. And so we've had some pretty significant contribution from Chinese biotech in our portfolio. As of the end of September, about 16% of the portfolio was invested in China biotech, and we think there's more upside to go. So right now we're about 44% below the peak highs in the middle of 2021. We do think, from a valuation perspective, a lot of the Chinese biotech investments will continue to perform going forward. So then I wanted to talk about kind of the political uncertainties that really arose after Trump's election that served as an overhang on the space that are now really lifting. So first off, I just wanted to emphasize that there are a lot of positives about the Trump administration with regards to biotech. We think overall the Trump administration is very supportive of the US biotechnology industry. The Trump administration is generally pro-innovation. That's consistent with Trump's broader domestic pro-business agenda. He's been a strong advocate for reduced regulation. And in fact, the FDA wants to reduce the regulatory hurdles to drug approvals and speed up the drug development process. And lastly, the industry does enjoy broad bipartisan political support. So recently, the Senate released a report that recommended further government support of biotech as a strategically important industry for the United States. Now, below that, there are a number of uncertainties that did arise after Trump's election, but fortunately, a lot of those uncertainties are now fading. And so I'm going to just go through these one by one. First off, of course, was the appointment of Robert F. Kennedy as the head of the Department of Health and Human Services. The investor fear there, obviously, was that he is a noted vaccine skeptic. As head of HHS, is he going to stymie drug approvals? Is the FDA going to become less science-based? What is the reality? We do concede that vaccine development is going to become more difficult, but drugs don't seem to be affected by RFK. And in fact, the FDA Commissioner, Marty Makary, seems very reasonable and science-based. We did exit all of our vaccine portfolio positions after RFK was appointed, just to avoid that policy uncertainty. But drug approvals seem to be going unabated and on course. If you look at budget cuts, that was another fear that investors had. They were afraid that budget cuts to the FDA by the Trump administration would lead to a slowdown of drug approvals. Thus far, we have seen no apparent slowdown in drug approvals. And in fact, the Department of Health and Human Services has said publicly numerous times that the drug review process will not be impaired by any budget cuts at the FDA. In fact, Makary does want more drugs approved more quickly. Next, drug price reform. Drug pricing reform has been a perennial overhang for the sector as long as I can remember. President Trump did introduce an executive order calling for what he calls most favored nation pricing for drugs in the United States. He's obviously very upset that Europeans pay a lot less for their drugs than payers in the United States. I would note that he introduced a very similar executive order during his first term that really didn't go anywhere. And our view is basically that this MFN provision would really require congressional legislation in order to take effect, and that's going to be very difficult to pass. Having said that, Pfizer just this past week did announce a deal that they made with the Trump administration where they agreed to offer MFN pricing for their Medicaid business. So these are the drugs that are sold to Medicaid, which is the government-sponsored program for health insurance for the poor in the United States. And Trump obviously touted this as a win in his quest to lower drug prices in the United States. The reality of the situation is that it's actually going to have a very minimal impact on Pfizer. That's because Medicaid represents a very, very tiny portion of Pfizer's business. Importantly, though, it does set a template deal for other big pharma companies to follow. So I would expect over the next few weeks, Eli Lilly, Merck, other big pharma companies to announce similar deals with the Trump administration about what they're doing on drug pricing voluntarily. Trump can tout that as a win for the administration. And hopefully we can move on from this as a topic of discussion and a focus of the administration going forward. Lastly, on pharmaceutical tariffs, Trump has threatened significant tariffs on pharmaceuticals. I just point out that the cost of goods sold for drugs is actually very small. These are high margin products. Biotech companies can change commercial manufacturing plans prior to launch to make sure the manufacturing occurs in the United States. And importantly, the deal that was struck with the EU recently actually caps pharma tariffs at 15%, which is very manageable for the industry. So we think the tariff threat has also dissipated quite a bit over the last few months. So overall, a lot of those overhangs have really pressured the sector in the late part of 2024 and early part of 2025, we think are abating, and that has allowed a nice recovery in biotech to occur. Overall, we do think the Trump administration is a net positive for the biotech industry. So let me conclude with just a strategy and outlook for the fund. The strategy of the fund is going to continue to emphasize emerging biotech over large cap biotech in order to fully capture the sector rebound that's taking place right now. We're going to continue to capitalize on compelling investment opportunities in companies that need to finance at low share prices. We're going to maintain an appropriate level of China exposure as opportunities arise in that geography. Gearing level, you should expect to generally stay between 5 and 10%. Just to emphasize that we are seeing unprecedented low valuation in emerging biotech, and that does suggest significant upside from current levels. The performance drawdown we've seen in small and mid-cap biotech in particular versus the S&P 500 has been the longest and most severe we have ever seen. That led to a high percent of biotech companies with market caps trading below the net cash on their balance sheets. That metric is well above historical norms. And we think that the catalyst, or one of the catalysts that's going to lead to a recovery, is the fact that the Fed has started cutting interest rates again. In this interest rate cutting cycle, if it continues, we do think that's going to propel the sector upward. The valuation contraction that we have seen over the past 4.5 years, we think is completely unwarranted and disconnected from the fundamental innovation in the sector, which remains robust. M&A activity we expect to accelerate given lower valuations of biotech targets and the urgent need for new products by big pharma. And as I just mentioned, we think that Trump administration is overall actually very supportive of the biotech industry, and a lot of the political overhangs there are lifting. So OrbiMed as a firm, we do firmly believe that this is an excellent time to invest in biotech innovation at unprecedented low valuations. So with that, thank you so much for your time, and Josh and I are happy to answer any questions you may have.
Thank you very much. Just a reminder, everyone, if you'd like to submit your questions using the Q&A button, we can then answer them. Just a first one off the table here. You mentioned in the latest fact sheet, Leeds Biolabs, which was another example of a cornerstone investment pre-IPO. You've done a few in the past, but how is the market looking for the pre-IPO cornerstone support at the moment?
So we've done investments in actually 2 recent China IPOs, one in a company called GenFleet, another one in a company, as you had correctly identified, Leeds Biolabs. They're both up, I would say, 80 to 100% from the IPO price, so they've been great investments. As a cornerstone investor, what that means is that we commit to committing a certain amount of investment in the IPO. Our name is actually mentioned in the prospectus. It's a great way to guarantee allocation in a very hot, popular IPO. But the trade-off there is that we are restricted from exiting the stock or doing anything with the stock for a period of 6 months. So we can't sell the position for a period of 6 months. That's a standard lockup provision. I would say we have been very selective about the types of biotechs we're going to be investing in China, but the IPO market is opening up in China. And so this is an area where I think OrbiMed has an advantage. There are very few firms out there that have the local China analyst presence, team presence, in order to get a cornerstone allocation in these hot IPOs. And I think one of the few firms that can do so, and hopefully generate some significant outperformance for our investors. So the IPO market, I think, is going to continue to improve in China. The US IPO market still very subdued right now. We're not seeing a lot of activity there. And so what that means is that we haven't made a lot of crossover investments in US biotech. A crossover investment is an investment in a private company in the last round prior to an IPO. Historically, we've done that. We have not done that lately simply because we don't see the runway just yet in terms of an IPO liquidity event for that investment in the near term.
What is the current exposure to China, and how does this compare to, say, 12 or 24 months ago?
Yeah, so if you see this on the slide here, here's our portfolio as of September 30th. As I mentioned, China exposure is about 16%. China exposure has gone as high as 20% in the portfolio historically. I think you shouldn't expect China exposure to go to 50% or something like that. We do have to be mindful of the geopolitical risk between the US and China. We want to be very, very careful about where we place our dollars there, making sure fundamentally they're robust companies. And we also want to be cognizant of liquidity. So again, if we do a cornerstone investments, we are locked up in that particular stock for 6 months. And we don't, we want to make sure to manage that liquidity appropriately. But I can say that fundamentally, the center of gravity of biotech innovation worldwide is shifting more towards China. And I think we're very, very well positioned to invest in a lot of those great innovative companies.
And just on that, has the increase in China over the last 6 or 7 months been mainly due to those holdings growing in market cap, or have you actually actively been adding to them as well?
It's a combination of both. Recently, frankly, we've trimmed back some of our positions as well, taking profits in some names where we feel like the incremental upside from here may not be as dramatic. But our expectation and the investment thesis for a lot of those positions actually are continued business development deals where a Chinese company strikes a deal with some big pharma company and gets a royalty on a potentially very large US market for that particular drug. And that's been a nice catalyst that really leads to a significant valuation inflection for a lot of those companies. We feel like a lot of the Chinese companies are in those discussions right now. Just to give you an idea of the types of prices companies are paying here, Pfizer recently did a deal with a Chinese company called 3S Bio. It's a portfolio company we own, where they paid $1.25 billion up front for a PD-1 VEGF bispecific, which has potentially broad applications in cancer. And so, some of the upfront payments that are being paid these days for Chinese assets is really spectacular. And if you had asked me, 15 years ago, 10 years ago, sort of what people thought of innovation in China, people didn't think much of innovation in China. They have really, really caught up in terms of the quality of the science and the quality of their programs in drug development.
There are a lot of sectors where innovation and change is happening extremely fast, and you've discussed this over the last webinars that you've been doing. But I mean, can you elaborate more on what the latest for GLP-1s, Alzheimer's, and other big ticket areas where perhaps they were slightly delayed by lockdown, and whether these have come, fully washed out now?
Yeah, so the GLP-1 story obviously is a tremendous success story, especially for the leaders in that space, Eli Lilly and Novo Nordisk. I think there is still some potential in the obesity area for biotech companies to play a part. For example, we have an investment in a company called Structure Therapeutics that has an oral GLP-1. Right now, of course, the GLP-1 agents on the market are injectable. You have to take a weekly injection. Wouldn't it be nice to just take an oral pill instead? But having said that, I will say that Lilly in particular, I would say, has built up a very, very sizable lead in that market. The presence there is significant. Their pipeline products, they have their own oral in development. They are definitely building a moat around that obesity franchise and will certainly spend a lot of effort in protecting that franchise. So I do think there's some opportunities in obesity and cardiovascular going forward for biotech, but they really have to pick their spots and make up for the fact that they're going to be later to market. Alzheimer's, very, very difficult condition to find successful agents. Biogen did have some success in developing an antibody for that, but it is so cumbersome to administer. It's an IV drug. You have to take an MRI beforehand to make sure you actually have the amyloid plaque that's they think causing the Alzheimer's symptoms. Then you have to go in for an IV injection every 2 weeks. So it's a very, very cumbersome agent to administer. And so the traction for that drug actually has been quite disappointing. Having said that, a subcutaneous formulation of that drug is coming up, expected to be approved in 2026. The ability to diagnose the amyloid plaque, they're now moving towards more of a blood-based diagnostic, so you don't have to go through an MRI. And other companies are working on Alzheimer's therapies. That is a significant unmet medical need. That is certainly a market that is on par, if not larger, than the obesity market. And we were going to pick biotech companies as they arise if they have interesting programs in that space.
Have there been any takeouts of holdings over the past year? And are you looking to invest in those names which might be taken out through M&A deals coming up in the near future?
Yeah, so I would say that if you look at our emerging biotech portfolio, many of these names, in fact, I dare say most of these names, we think would be attractive M&A candidates for a larger player. I've noted in one of the previous slides that we have had a number of portfolio positions get taken out. It's a little bit of a random process, I'll be honest with you, in terms of the timing of some of those takeouts and who gets taken out and the premiums of some of those companies. I think the last significant one for us where we had a big position was a company called Intracellular Therapeutics. But look, I think over time, every year we're going to catch a few of those M&A transactions, and that will be a contributor to performance for the trust. I will also note that sometimes a company gets taken out, and then there are other companies in the exact same space, and their share prices also rise in sympathy with the takeout, with the name that's taken out. So sometimes you actually benefit from the M&A activity, even if you aren't in the specific name that was taken out, just because that transaction kind of floats all the boats higher, if you will, in that particular therapeutic area.
As I commented on at the beginning, the share price is up from the low in April, around £6.20 to over £10 now. Obviously, it's had a good run. July, particularly, I think the net asset value was up 17% in the calendar month. I mean, are there any particular reasons why it's being either pushed up, or is the weight in that sentiment in the market so great that any alleviation just allows it to bubble up? Is it a combination of both?
Yeah, so if I could just turn to that slide showing these indices, I cannot emphasize enough how unprecedented this relative performance has been of small cap biotech versus the broader market. Generally speaking, if you look historically, actually, biotech has outperformed the S&P 500. Here we see massive underperformance that we've never seen before. And additionally, it's unjustified based upon the fundamentals. We're seeing great fundamentals for the industry. So there is a massive mispricing in our view of the biotech sector as a whole. And so you ask, well, what's led to the recent strong performance? I think at some point, this valuation gap just becomes so egregious that, as you have correctly identified, any lift of an overhang, like political uncertainty dissipating, the Fed starting to cut rates, any little hint of some positive dynamic is going to lead to a recovery in the sector. And so we think we are still very much in the early stages of a sustained biotech recovery. And as I mentioned earlier, again, absolute valuations are still very, very depressed in a historical context. How many other sectors out there in the S&P 500 are trading at near record lows? Ask yourself that question. And I think, it really presents a compelling investment case for biotech right now.
And we're obviously across both sides of the pond used to perhaps not so accurate guidance from politicians and central banks at the moment. But as you said, I mean, the central banks and politicians, are they just putting a dampener on the overall market? But can the market I suppose, punch through that through, great news on innovation, or are we actually just waiting for politics and central banks to essentially open the door for it?
Okay, so I want to be very, very clear. I did mention interest rates as a potential catalyst for a recovery, but I want to be very, very clear that frankly, we think the biotech sector can outperform even if there is no decrease in 10-year rates. And the reason why is because if you look at these levels, we've seen these levels before, 2005 to 2008. And back then, valuations were not nearly as depressed as they are now. So even if nothing happens to interest rates, say, we don't think that will be a hindrance to a recovery in the sector. We think at the current interest rate level, the recovery, the sector should be able to perform based upon the fundamentals. New drugs getting approved, clinical trials being positive, M&A transactions happening. All of those are true value-creating events for these companies, and as long as value is being created, share prices should follow.
The Biotech Growth Trust has a relatively high portfolio turnover. I mean, given the sort of volatility in the market, how's the concentration of the, say, top 10, top 30 in the portfolio changed? Has it become greater or less? And also, how are you putting to work all of that expertise with OrbiMed to manage that sort of constant portfolio turnover and analysis internally of what's.
Yeah, so I think a lot of the advantages that we can bring to bear in picking stocks in biotech, we have a lot of scientific expertise and so forth. They're best applied, frankly, to the smaller and mid-cap areas of the biotech universe. And that's one reason why we do have a small cap bias in the portfolio. In terms of the turnover, a lot of the turnover is simply due to risk management. Here's a slide on risk management in the appendix. I think the slide deck will be posted online on our website. But if you just look at the volatility of the stock constituents, as you go down in market cap, predictably, the volatility does increase. And so a lot of the turnover that you see is actually risk management. Before some sort of binary catalyst, we want to make sure we don't lose more than 100 basis points of performance. We might cut down the position a little bit to manage that risk. So yes, there's quite a bit of turnover in the fund. That's a function of kind of the area of biotech where we're playing and believe we can add value. But we have a pretty big team of analysts that are all assigned to cover a discrete number of biotech companies. And yes, we review actually on a weekly basis. We go through the portfolio, every single name, just to make sure we're right-sized. It's appropriately sized for the risk that we're taking. Any change to the thesis, is the thesis still intact, et cetera. And we make changes appropriately. In terms of concentration, frankly, I wouldn't say that's changed too much. You can see it here. We have a few emerging positions that are 3 to 5% of NAV, but I would not say the overall picture of the portfolio construction has actually changed that much over the past 7 years.
Obviously, Biog is a London-listed vehicle, but predominantly, with a US exposure. We sit on this side of the Atlantic, but obviously politics has become globalized. So do you think that the UK investor is perhaps overcautious on the state of US politics from your point of view as residents, and you have a closer watch and a tighter hand on the goings on over there?
Yeah, so I think really one of the principal reasons why this trust even exists is really to give an opportunity for UK investors to invest in the great biotech innovation that is happening worldwide, most of which is happening, frankly, outside of the United Kingdom. And so this is a great way to get exposure to this very exciting industry and innovative industry. My perception, though, is that yes, UK investors right now are fairly risk averse. This is a risky sector. I will concede that it's a volatile sector. A lot of these companies can go up and down in a very rapid fashion. I would say, though, that the recovery, and again, I think it's going to be a sustained recovery going forward. Just as the drawdown was frankly fairly rapid, we think the recovery can also be fairly rapid. So again, I would just say we have valuation support here. Stocks are still trading at unprecedented lows. We have great innovation occurring fundamentally in the sector. I think it's actually less risky now, given those parameters, given those conditions, where you think to yourself, okay, record underperformance versus the S&P 500. Is there a lot of downside risk from here? We would argue no. We think there's a lot of upside opportunity and not a lot of downside risk. We don't think the sector is going to get cheaper from here. It's already at sort of these bargain basement levels. So that's the kind of message that I think I would communicate to the UK investor base, and obviously, it's their decision about sort of where to put that money.
Do you have any views on the risk of dollar weakening in terms of the pound sterling NAV returns in Biotech?
So look, currency and calling currency moves is not our expertise. So we don't even attempt to do that. So you're right. This fund is subject to currency fluctuations. We do not hedge currency moves in this fund. We think that as an investor, if you have a view on currency, you can do that sort of outside of this fund. We're just going to stick with our knitting and what we think we can do, which is pick great biotech stocks wherever they are in the world. So I don't have a view on currency. I think it would be misplaced for and really an uninformed view if I try to make a prediction on currency moves.
Excellent, thank you. It looks like we've got to the end of the questions. If anybody has any other question, please type extremely fast. Otherwise, I think we might look to wind up the webinar. But thank you both so very much for your time. Obviously, if there are any further questions that anybody who's listening, please email ir@frostro.com. But we will post the recording of this out once it's been signed off and edited, along with the presentation slides. So again, Geoff, Josh, thank you for your time. Really appreciated. And to echo my colleague, Neil Winwood, don't be short of investment trusts, especially the Biotech Growth Trust. So thank you again, and we're looking forward to seeing you at the next webinar. Thanks very much.
Thank you.